Welcome back to DeFi Supply. Today I'm going to talk about the top bear market farming strategies to use during this volatile period within the crypto market. In this video, I'm going to go over 3 strategies that I think are still very valid during this period. The first one is Lido Finance and Convex, so you can get about 5 to 8% on your ETH. The second one is just simple Aave Lending, where you can get anywhere between 1 and 8% on stablecoins, depending on your risk tolerance. And then the third one is Uniswap. So obviously, right now we're in a bear market within the crypto space. We're down roughly over 50% from all-time highs. Just from a Bitcoin point of view, many altcoins are down way over 50%, including Ethereum. And there's many short-term bearish factors coming up that I think will cause the whole market to continue to decline. Some of these I've outlined here. So the first one is quantitative tightening by the Federal Reserve is going to continue for the next few months at least, but likely through the end of the year in order to dampen inflation within the US. And then currently we're also dealing with supply chain issues, which is just further impacting the bottom line within the economy. And so generally this is negative for equities. And so when equities are down, the dollar is strong. And the crypto market and equities are generally correlated in that crypto companies and crypto protocols are kind of new technologies. And when the whole market in the world is fearful, generally these speculative assets are going to be in a lot of pain. The other one that recently happened was the UST collapse. So roughly $60 billion in liquidity was just erased from the crypto market because the UST stablecoin depegged and eventually fell to only a few cents, which in turn caused the crash of the Luna price. And this death spiral that occurred put a lot of fear throughout the entire crypto market and actually depegged USDT shortly, just due to all of the FUD going around that stablecoins weren't actually that stable. And so Bitcoin actually briefly touched, I think, 25K at one point. So these are the bearish events near term, but I'm still bullish long term on crypto because we have ETH 2.0 coming up, Bitcoin halving, of course, coming in 2024. And L1 ecosystems are still going, they're still innovating. Tons of new protocols and new ways to interact with the blockchain. The other one that I think is going to be huge is regulation is coming. So it's going to be bringing more institutional investors into the crypto space and in turn just provide more liquidity for the entire ecosystem. So without further ado, here are the 3 strategies that I'm going to be deploying during this bear market. So the first one is Lido and Convex. So Lido is basically a protocol that allows you to stake your Ethereum on Ethereum 2.0 for roughly 4% yield while giving you a token in return for you to trade or use or send to other people while the Ethereum that's backing this staked ETH is locked up in ETH 2.0. So it just allows more utility for the staked Ethereum token. And so what you want to do with this is you're going to go to Lido, take Ethereum, and provide it to Lido, and they're going to give you staked Ethereum or stETH in return. And you can do one of 2 things with this. You can either say, I'm happy with the 4% and just put all of that into your wallet and just kind of let it sit there. Or you can take that stETH and actually put it into a curve pool along with some Ethereum, just normal Ethereum, non-staked, and basically receive liquidity pool tokens from Curve once you deposit ETH and stETH into Curve. And with those liquidity pool tokens from Curve, you can then deposit that into Convex, and Convex is going to take those liquidity pool tokens and basically boost the rewards that are paid out to liquidity provider, and basically boost rewards given to liquidity providers. And that's going to be roughly 5.5% APR on basically this ETH stETH combination that's given to you from Curve. And so if you calculate the total APR, we're going to get about 6.75% currently. And this is going to fluctuate a few percent up or down, anywhere between like 5% to 8%. So this is actually really good if you're long-term bullish on Ethereum and you just want more Ethereum. The stETH is going to be increasing in value 4% a year, because all of those stake rewards are just going back into the token that you're holding and the value that's associated with it. You're also going to be rewarded in Convex and Lido tokens as well. So, so it's a little bit riskier if you hold on to Convex and Lido. So I would recommend basically just selling it or keeping a small portion if you believe in both of these projects long term. So to demonstrate how to do this first strategy, you're first going to want to go to Lido, and you're going to click Stake Now, and you're going to select Ethereum 2.0, and it's going to prompt you to, instead of minting stETH by just providing Ethereum, it's telling you that you can actually just swap it to stETH, because other people are just trying to sell their stETH for regular Ethereum, and that demand has a bit of an imbalance right now. So you're actually getting roughly a 2% discount on Ethereum by just swapping it rather than minting. So most of the time you're going to go to 1 inch and actually swap it instead of minting stETH. So I'm going to go to 1 inch, and it's going to direct you exactly to the place where you can swap. So for example, if I wanted to provide 1 ETH, you can actually get 1.018 ETH in return, which is a roughly 2% immediate gain. So pretty good deal. The risk is if you want to come back from stETH to Ethereum, you will incur that kind of 1.8% loss if the demand is the same at the time you want to sell it. But if you're long-term bullish, I would say that this is a very good deal. Then once you have your stETH in your wallet, you want to go to convexfinance.com, and you're going to scroll down to kind of this list of pools that you can provide to, sort by TVL, and you want to find the pool name called stETH. You're going to click on stETH, and you're going to click on this link, which is going to bring you to Curve, which is where your actual assets are going to be deposited. And you can either provide, 50-50 ETH and stETH, or you can provide all ETH or all stETH. No matter what, though, it's going to be split roughly 50-50. So if you provide 1 ETH, that's going to be sold, or half of it's going to be sold into stETH, and vice versa. And then once you deposit these assets, you're going to be receiving liquidity pool tokens. And with these liquidity pool tokens, you're going to go back to Convex and actually deposit and stake these liquidity pool tokens to begin earning this 5.68% APR. The second one is a little bit simpler. It's just lending on Aave. So Aave, like many of you know, is a money market lending protocol, and you basically just provide digital assets, and you can either just let it sit there and be used to have people borrow from you, or you can use the crypto that you've provided Aave and use it as collateral and actually borrow money from it. So that's a little bit more risky. For this video, the bear market video, I would suggest just putting it into Aave and collecting an APR of 1 to 8%, depending on the asset that you provide and depending on which ecosystem that you provide it in. So one ecosystem that you can provide it to is Avalanche. So you can take your DAI or USDC coin or USDT and provide it for, a few percent. So this 1.2%, for example, is going to be paid out in AVAX, and 1.1% is going to be paid out in the underlying token of DAI. And you can also loan out your Bitcoin and Ethereum for a very low amount, like 1.5% or 0.2%. But generally, you would only use these if you want to use them as collateral. I would just stick with lending stablecoins out. The third strategy for the bear market is to just do simple liquidity pools with relatively stable assets. Now, in this example, I'm going to be using wrapped Bitcoin and Ethereum, but you can also use this for stablecoins like USDT, DAI, and USDC. But for this example, I'm going to be going to Uniswap and depositing wrapped Bitcoin and Ethereum. And basically, you put 50% Bitcoin and 50% Ethereum into this pool, and they're going to give you liquidity pool tokens in return. And those liquidity pool tokens are going to be associated with an increasing value, because if someone trades Bitcoin for Ethereum on Uniswap, they pay fees, and part of those fees go to you because you helped make that happen. And so your rewards are going to be mostly rewarded in the Uni token, and you're going to be most likely wanting to sell the Uni token to a more stable asset, or if you want to kind of take more of a risky approach, you can hold on to that Uni. But I'm personally going to be just kind of dumping Uni and taking it more into a stable asset. And the total APR is going to be around 20%. And the way that I found that out is by going to a really cool site called Coindix. And here, it has basically all of the different APYs for every protocol. So if you scroll down and you find wrapped Bitcoin and wrapped ETH, this is the liquidity pool that you're going to be using. You can actually look at the different APY and how it's fluctuated over the past year. So, at its peak, in May, it said 90% APY if the volume had maintained during that period. But you can generally see that the APY is fluctuating between, anywhere between 2% to like 12%, maybe even 20%. So, probably between 10 and 12% APY for this. At certain times, you're going to hit that 20% APY mark, but really it just depends on the number of people that are in this pool and the number of people that are using this pool to make transactions. So with these three strategies, there is some element of risk. Every strategy within DeFi has some risk to it. And here I've ordered it based off of the risk. So 1 is going to be the riskiest and 3 is going to be the least risky. So Uniswap is going to be the most risky because, well, first of all, you're trusting that Uniswap is not going to get exploited. Now, it's a very safe protocol, in my opinion, compared to many other protocols, but it's not guaranteed. Most of the risk is that your entire value inside that pool is up to crypto volatility. So if Bitcoin declines in price or Ethereum declines in price, you're going to be taking the full force of that decline in the total value in your portfolio. And the second one is with Lido Finance and Convex, you need to trust that Lido is not going to be exploited, Curve is not going to be exploited, and that Convex won't be exploited. And the other one is if stETH depegs, then the underlying value of your Ethereum is going to decline and probably crash. Now, all stETH tokens are backed up by Ethereum or locked Ethereum on the Ethereum 2.0 network, but there are going to be times where the difference between stETH price and Ethereum price will be significant. So definitely watch out for that. And then the third one is the least risky, but still has some element of risk because you're lending assets out to people. So you're trusting that Aave won't get exploited and will have enough funds to pay out when you withdraw the assets that you're lending to other people. The other one is if you are lending out a stablecoin, make sure that that you've researched that stablecoin and kind of mitigated the risk of that stablecoin depegging. And then finally, I just want to talk about risk during bear markets. So the first one is that altcoins generally are going to perform worse against Bitcoin. So, Bitcoin and Ethereum are going to be your best friend during this time. Even though both will likely decline, they're still going to outperform the declines in most altcoins. And the second one is that all protocols are subject to collapse. We learned this with UST and Luna. I personally was invested in Luna and lost a lot. And so you always have to make sure that whatever amount you put towards a certain protocol or to a certain coin, you need to be okay with losing all of that. So that brings me to my third point, which is to never go in or never go all in on one protocol, coin, or ecosystem, and that you should spread your risk across multiple investments. Because in case one or two fail, your overall portfolio is still going to be okay. And that's all for the video. So if you want to follow me for more, you can follow me at DeFi Supply on Twitter or follow me on YouTube at DeFi Supply. Thanks again, and I'll see you next time.